Welcome to SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. The International Monetary Fund has praised Sri Lanka's strong economic recovery and approved a $334 million disbursement under the Extended Fund Facility, bringing total funding to $1.34 billion. Key economic indicators are improving with low inflation, high revenue collection, and growing reserves. Since the third quarter of 2023, GDP has averaged 4.3% growth, and by the end of 2024, nearly 40% of losses from 2018 to 2023 are expected to be recovered. However, the IMF warns that the economy remains fragile, stressing the need for continued reforms to maintain stability and avoid policy missteps. While most program targets have been met, social spending goals fell short. The fund urges stronger tax compliance, targeted social support, and cost-reflective electricity pricing to sustain growth. Debt restructuring is progressing, with the recent bond exchange seen as a key milestone. The IMF calls for swift finalization of the agreements with remaining creditors. It also emphasizes the importance of maintaining price stability, safeguarding central bank independence, and addressing structural challenges to unlock long-term growth. The Central Bank of Sri Lanka is set to purchase $2.65 billion in net foreign exchange from the domestic market between November 2024 and the end of 2025. The move is part of ongoing efforts to rebuild the country's foreign reserves. According to the latest IMF staff report, Sri Lanka is expected to reach a reserve target of $7.06 billion by the end of 2025, covering approximately 3.2 months of imports. The central bank has confirmed its commitment to achieving this target through strategic foreign exchange purchases. This comes after Sri Lanka recorded its highest ever net foreign exchange purchases of $2.8 billion in 2024. Authorities say the country is gradually rebuilding its gross international reserves through market purchases, a current account surplus, external financing, and sovereign debt relief. Additionally, Sri Lanka expects $783 million in foreign program financing linked to the IMF-supported program. With a positive external outlook, authorities plan to maintain reserve accumulation, aiming for a net international reserve target of $2.6 billion by the end of 2025. The central bank has also outlined a strategy to safeguard any overperformance in reserve accumulation. In case of higher than expected reserves, it will consult with IMF on adjusting future targets. Sri Lanka is taking a bold step to boost its tourism sector. The government has identified 100 new locations as tourist attractions and plans to invest 1 billion rupees, around $3.4 million in developing essential infrastructure in these areas. Tourism Deputy Minister Ruwan Ranasinghe announced that as part of the Clean Sri Lanka National Programme, visitor centres will also be established this year to enhance the experience for travellers. Tourism remains a key driver of Sri Lanka's economy, contributing significantly to foreign revenue. The sector has shown resilience despite recent challenges, and authorities are pushing forward with efforts to attract more visitors. The new initiative aims to diversify tourism offerings, reduce overcrowding at popular sites, and promote lesser-known regions. The industry has faced setbacks in recent years, from the COVID-19 pandemic to the economic crisis of 2022. However, with global travel rebounding, Sri Lanka is positioning itself as a prime destination for travelers seeking unique and off-the-beaten-path experiences. The government's efforts are expected to create new employment opportunities, stimulate local economies, and support the country's post-crisis recovery. Tourism stakeholders remain optimistic about the sector's potential and the positive impact these developments will have on the economy. Crude oil prices remain under pressure after hitting their lowest levels in nearly 4 years earlier this week. The decline was triggered by new U.S. tariffs on Mexican and Canadian imports, which took effect on March 4th, sparking a market sell-off. Adding to concerns, OPEC Plus has confirmed plans to partially roll back production cuts in April, raising fears of increased supply in the coming months. On March 7th, Brent crude traded at $69.72 per barrel, while West Texas Intermediate WTI stood at $66.72, both recovering slightly after opening in Asian markets. Meanwhile, the U.S. Energy Information Administration reported a crude oil inventory increase of 3.6 million barrels for the final week of February. Market watchers, however, remain focused on the build-up, largely overlooking decline in fuel inventories. Since the beginning of the year, crude prices have fallen by 20%, with analysts pointing to global trade uncertainties. Recent U.S. trade policies continue to disrupt markets, with affected countries responding with countermeasures. With supply-demand imbalances persisting, analysts warn that market conditions remain fragile. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 7.53%, down by 4 basis points. The 182-day T-bill rate stands at 7.86%, down by 3 basis points. And the 1-year T-bill rate stands at 8.34%, showing down by 1 basis points compared to the previous week. Thank you for watching. We'll be back next week.